Welcome to Levi's Arc Trading Channel. It's not quite done yet. Presto. So basically, today we're going to talk about why I think double projections work and why they don't. Essentially, because I was kind of a bit confused about how they kind of fit into the circle of everything. So this is essentially my breakdown. Enjoy. So this is a picture of a Demark. So this is essentially what a TD point is. So a TD point is essentially, well, this is a TD point, this is a TD point, this is a TD point, and this is a TD point. So why are they TD points? So essentially, it's the highest point between, there's a candle that is lower. So as you can see, this candle here is lower than this candle, and the candle here is lower than this candle, because of candle 1, candle 2, and candle 3, we then get a TD point, right? So why is this one, for example, not a TD point? So essentially, if we go next to this candle, so this one's lower than this one, but because this one is higher, right, this is not a TD point, so that's not valid. And there are different magnitudes. So there are different magnitudes. There's 1 to 3, I think. So this is only a level 1. It's only a level 1 because it has only one candle beside it. This has 2 candles, but on the other side it only has 1 candle. So it's still a level 1. But if they both had 2 candles either side, that's a level 2. Alright, moving past the point. So essentially, not all of these are created equal, basing on the entire on where it is on the time frame. So if you're on, say, the monthly chart, say this was the monthly, this chart here is going to have way more precedent than, say, a minute chart. So essentially what I'm saying here is essentially on the monthly, a validation on the monthly is going to be way stronger than a validation on, say, a minute chart. And the reason that is, on a minute chart, right, there is less data, less context. There's not really much to go on other than that specific time frame. However, if you scale up, then you get a different degree, and then that degree is going to be stronger than the minute chart. So a 5-minute chart is going to be a lot stronger than a minute chart. So if you get a confirmation on there, right, it's definitely going to steer what's happening on the minute chart. And conversely, everything kind of spirals back. It spirals back, but it doesn't work the other way around. You can't necessarily base, okay, cool, I've got a confirmation on the minute chart, right, and then all of a sudden you're holding a trade for way too long for no reason, because you didn't look up the high time frame, aka the monthly, and then kind of go, okay, cool, what's going on here? So essentially, if you get a confirmation on the monthly chart and you want to dribble in a little bit, then it's a good idea to trade in that direction. So context, why would we validate our projections? Essentially, if you validate your projections, then that projection you can essentially use. But see, if you just get a random TD point and it's not confirmed, that projection is completely useless. I mean, don't even bother, really don't. So how would I confirm it to go about it? So we're just going to go through this real quick, because I think that would be, yeah, that's a good thing to do. That is what we want to do. So what we're going to do here, we're going to look at this area, right? That's a terrible circle. Okay. Basically, we're going to look before the break. So 2 candles before the break. So 1, 2. Alright, cool. This is the break. See? It broke the line. That's the ting. Make that real clear. So this candle here has to close above the previous candle. Follow? So how candles work. So let's say this candle opens here, right? It opens, and then price travels down a little bit, comes back to the open, comes up, comes back down, and then closes, right? Instantly after then, a new candle is formed, right? But obviously this one's a little bit fragmented. This is actually taken from a live chart, so it's obviously gapped down a bit. So it opened up here, right? And then it obviously came down, came back up, and then closed here. But you see, because it opened here, yeah, there we go. So it opened here, and then it closed here. And then this one opened, and then it closed here. So as you can see, it closed above this one, and then that means for at least a sell trade, it's validated. But for a bullish trade, it's different. It's the opposite way around. For a bullish trade, it has to close below. But we're going to do that maybe in another video, just because this is kind of taking up a lot of space. This is not the only way to validate a trade as well. So the second way to validate a trade is through a gap. Essentially, what would happen is price would be wiggling around, and then all of a sudden the candle would appear above breakout price. So it would just completely miss the line, and it's very easy to see. Anyway, the third one, right, which is a bit weirder. So essentially, you would take you could either measure between the close to close. So the close to close is this measurement here and this measurement here. If this measurement that you've taken, so this little box here, is less than breakout price, so you would take this little box and then move it down, right? If it is less than breakout price, so before it broke, then it is validated. So in this case, it's validated. I've obviously done an example where both is effective. The second version of this, you would measure between the low of the previous candle, right, which is prior to the candle that broke, and the open. I think it is the open. So it's literally like the low to the open, and then this variant here, if that is less than breakout price, it is validated. But if I'm wrong, I'll probably correct that later. So the third thing is like strength of the market. So how can we tell this through like indicators? So this is kind of like how I was kind of picturing things. So when I was looking at the MACD, so obviously we have the first thing we're going to talk about is convergence. So convergence is when price is agreeing with your indicators. So essentially, when you get a low, so a low here, you would also get a low on your indicator. So it would sort of like dip, and then when it gets lower, say again, like makes another low, it would make another low on the indicator, and so on and so on. So price would agree with your indicator. So that's convergence. So convergence helps with like the overall view of like price, but I wouldn't necessarily just take that point alone and basically go, okay, cool, that's going that. It's just kind of like you have a general idea of like where everything's sort of going. So like let's take this tiny section here. Let's say there's a TD point between, there's a low here, there's a low here, and then we draw a line between this part. Okay, cool. So we've established our TD point. TD point is broken. So what's going on with this price? Essentially, so we've got the whole picture. So say this is past history, and we've got convergence between, now we've got weakening here, so we've got like, this is where it starts to dip, and then so we've got our low here, and we've got a low here, and then we've got a low here, and then we've got a low here. So all of a sudden we've got like some kind of like agreement going on for this TD point. And then we move on to the stochastic. So also what I've viewed as well, like it going into the 80% marker to 70% marker, and the 20% marker to the 10% marker. And what I did with my indicators, I essentially color coded them. So when it was here, I color coded it red, and when it was here, I color coded it green. That way I could kind of go like, okay, so that's just what's going on. I don't have to take a trade. It's just an observation. It's just like, just to go like, okay, cool, something's going on here. And then we have our RSI. So there's like two ways I tend to use this. So like personally, I think the best way is like momentum wise. So essentially this 50% is 50 line. I'm not 50%, 50, yeah, 50 line, or 50 value. 50 value, I like that, 50 value. So this 50 value line is essentially, if it's below the 50 value line, then essentially what price is saying is it's bearish, and if it's above, it's bullish. So obviously, as we know already, so bullish is going up and bearish is going down. So essentially it's basically agreeing that there's bearishness in the market. So how I was using it was essentially, when you get a TD point in a bearish market, if you use it as a demand, you would draw essentially a demand line. So this here is a demand line. So you would get a demand line for a bearish setup, and you would also get the same thing on your indicator. So you would have your demand line, and if price agrees at the same time, and you have price in the 70% zone to 80% zone, and you've also got your demand line, and that demand line's broken, you've got nice convergence, then you're good. You are going in. Most of the settings for these indicators are normal. Like obviously the stochastic is a 14, 3, and the RSI is just a 14, and then the MACD is different. I think it's 821.5. So essentially the MACD settings, I'm afraid to say, are shit. So you just have to kind of like tweak them a little bit, but that's just the one I used, 821.5. Remember that. The other thing I was thinking about as well, below the 50 value and the 30 value, well, between the 50 value and the 30 value, is essentially the distance between these two areas. So if like the line, that the squiggly line is like, you know, like quite high up before it reaches the 30%, I'm wondering if it hasn't reached the 30% on a higher time frame, could you extend it for that reason? But I figured it out, but we'll get there. But before that, consider it. It's just a thought. Like if it hasn't arrived at the 30 value yet on, like, say the monthly, could you hold? But essentially the problem with that is you would have to have, well, a suitable stop. You would have to be quite far away so you could allow for pullbacks and fluctuations. But if you are quite close, could you risk essentially, because obviously it could arrive at that target, but how it's going to get there is an entirely different story. So you would have to plonk yourself in a very, very good spot. But if you are in a very good spot, it's something to consider. I'm sure you're all eagerly waiting, as I've not even explained what a double projection even is yet. However, before that, let's just talk about economics. Essentially, I was thinking, obviously, if price was to travel a certain distance, aka like very, very far, and you would obviously make thousands and thousands of pips, maybe just hundreds depending on the market. Points, it would have to do something with the economy, which I haven't exactly done a lot of research in. In fact, I don't know anything about politics or fucking like world events or anything like that, so I think I should probably buy a few books on it. So it's a start, but I think for price to move that much, it has to do with something that's going on in the world. I mean, realistically, and if you can kind of like, I know there's a lot of people out there like, well, I think it's called fundamental analysis. Yeah, that's it, fundamental analysis. There's a lot of people beef with like people that do technical analysis, and then some people with like that are very like fundamental heavy. So I mean, like, who knows? I mean, like, I think it's just like have best of both worlds, you know. Why do we have to all beef? So let's get into the nuts and barrels of projections. So there's 3 types, but to be honest, I'm probably only going to go through 1 or 2 because that's all I remember. So essentially, you would take the highest point in this case, because we're downtrend, the highest point, which is this here, this variant here, just above the candle, actually, just above the candle. I don't know why I even did that distance. Essentially, above the candle, the measurement between the top of the candle and the TD line. So essentially, you would take this, you would take a line, you would have it in like your storage thing, and then you would just draw it between here and here. I mean, it would be very straight. It would be a very straight line. And that measurement there, you would add it to breakout price. So you would add this whole value, boom, to here like that. And that would give you your single projection. So you would have your single projection between here and here, right? Now, doubling it obviously just means this times 2, like that. So you would have boom, boom. And that's what double projecting is. And that, yeah. Essentially, projections, I think he calls them projectors or projectors or something like that. I'm not really sure how it's pronounced. I mean, I'm probably just being really dumb, but essentially it gives you a value of where price will go. So if we just label this X and this Y, that's the measurement. We'll add that, boom, 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 and then you get your value, and then that's how far price will go for that specific TD point, providing you're confirmed, more specifically, one of the 3 things we discussed. So now we're going to cover some risk management. This is just so you don't blow your account, preferably, and you actually make money from what you're doing. So essentially, like, the risk is the very highest point for this demand line, bearish break. Essentially, the risk is between here and the point where you take it, or where you've taken the trade. So the point where it's penetrated the line. So you would take your trade here. This is your entry. Yeah, that's your entry. And this here is your stop. And the pip value between here, so say, I don't know, 10 pips, boom, boom, like that. That's your risk, and then your reward is this. So sometimes, like, the value of this is a little bit, it's usually equal to about a 1-to-1, right? But usually, but let's step back. Let's step back a second. 1-to-1. It's not a lot, is it? Hey, here's the cap. Some of them are larger than others. So say you have, like in this case, right? You have a lower high before the lowest point. You can actually slam your stop right there. See, because we've got a high lower. So you can have your stop here. Now essentially your risk amount is between here and here, and now you've just increased it to maybe a 2-to-1. So now we've got 2-to-1. Okay, cool. That's just if we're just taking the standard trades on the higher time frames or the lower time frames. But here's the cap, right? If you have a higher time frame, so say we have an hourly chart. So we have I have no space to write. So say we have an hourly chart, right? And we have this showing. Okay, cool. That's what's going on. And we go down to a lower time frame, right? And we see a similar setup happening that looks well, it doesn't look exactly like this, but essentially you've got another setup, bearish, right? Going in the same direction as a higher time frame one. But you don't spot that one yet. So you essentially take the trade that is confirmed on the lower time frame, you'll scroll up and find the different confirmed projections, right? For the hourly, the 4-hourly, even the daily, or even higher, right? And then you would essentially just follow it along, and you can increase your risk reward quite stupendously. I mean, stupendously, like ridiculous. We're talking like, I don't know, you could go like 28 to 1, 30 to 1, you know, like it depends on how good you get at doing it. But like, to be honest, like the most I've ever actually done, I'm in a trade right now and it's like a 28 to a 28.6 to 1 ish, give or take. The first time, it's not the first time, like I've flopped it many times, but this is kind of like where everything's guaning. But there you go. The point is, you can get really mad with it. So essentially, you could take your risk management is essentially, as long as it's above a high, you're safe, right? A high in that TD, because that's valid. However, if you say you put it, I don't know, here, but it's not above a TD point, right? You're gonna have a problem, because price could literally come back up, hit this bit, and then come back down, but you didn't put it here. So in other words, your safe risks are basically where the TD points are on your TD point, and you can use different TD points across different time frames. But here's the cap: if you're using a higher time frame projection, aka a confirmed projection from a higher time frame, you can't trail it really and hit that hit that projection unless you want it to like stop out before it hits there. So you're gonna have to let it fluctuate like a lot before it gets to this point. But if you wanted to trail it, you could. It just know that it probably most often, half the time, will not hit that target, because you're going to have much larger pullbacks on the lower time frames than you would think. So here's the big reveal: to double project this value twice, essentially it's a smaller part of a grander TD point. That's the cap. So essentially, a TD point on a larger time frame, hold a mark line, is essentially that single projection that is caused by that is actually a double projection on a lower time frame. And it sounds really simple, but it's kind of not, because you're just like, you would have to look for everything and then basically kind of go, okay, cool, and then kind of go, okay, if I double this is actually equal to this single projection, and you got to kind of like match them all up as well, which is where kind of price matching comes in. Because if you can kind of go, if you can get the same price target for multiple TD points, that would suggest that is a highly valued target. But there's lots of things to think about, like, so if you can double project but base off a single projection, why don't you just take the single projection? I mean, to be honest with you, I guess it's like this idea of feeling safe. So if you go with just a single projection, because you just look at a single projection on a higher time frame, it's like, oh, that's great. But say you're already in a trade, right, and you can trail on that time frame if you wanted to go further and see how far it went, but you didn't want to just risk the whole thing and let it float because you wasn't necessarily sure about it. So I guess it's kind of like a safety net, using the double projection, because even though you say, oh, okay, I want to double project because the market's strong, but in reality it is just following another projection, just happens to be an individual that makes any sense, because that single target by itself is essentially not enough to persuade you, especially if it's like a monthly chart. That single target, there's a lot can happen in that time. That it's a month of data, whole 30 days, a lot can happen. It can go up, down, and it could take months to reach that target. So essentially you would be in a trade for months and you don't even know if it will hit or won't. I mean, nothing's guaranteed anyway, but the point is it's just way more risky to just sort of like let it float. But if you had like a double projection, you could take the first value and then kind of watch it on a lower time frame and then scale even down and then trade it from there, and then kind of go, okay, cool, so I'm safe. I've got my first projection off of, say, the daily chart, and then all of a sudden, like, you're scaling from the weekly chart, and then now you've crawled into that section, then you've gone from the monthly chart and you're like, oh, okay, like, I can scale in a little bit more, but then you're taking your profits, you're moving your stop, so you're positive and you're safe essentially. But yeah, no, that's the cap. So yeah, let me know what you think. If you agree, disagree, plonk it in the comment section. Just trying out new things, you know, what's gone and stuff, and enjoying life. Whoops. As always, like and subscribe if you want to, you know, because that's like, it's all about support, bro. The support, I feel that rain. But yeah, no, honestly, like, let me know what you think.